You finally have more money. The first upgrades most people make are loud: a newer car that still depreciates every year, a bigger house that brings higher taxes and constant maintenance, a watch that only works when someone notices it on your wrist. Those purchases feel like progress in the moment. 10 years later, almost no one calls them smart. The upgrades that actually matter stay invisible. They do not photograph well. They do not impress strangers at dinner. They quietly protect what you already have, recover hours you never get back, cut downside risk, and compound without requiring an audience. This list is 10 of those upgrades, ordered by how much they quietly hand back, protect, or compound over time. None of them require inheritance, perfect market timing, side hustles, or extreme routines. One of them you can finish today under 20 minutes if you start now. Every item on this list has to pass the same test. If the only time it pays you is when someone is looking at it, it belongs in the other category. The ones that survive a decade of hindsight are the ones almost nobody notices, and that is exactly why they work. Number 1. Update every beneficiary designation. A 2024 Caring.com survey found that 64% of American adults still lack a will, and even people who already have retirement accounts frequently leave outdated or completely missing beneficiary forms on file with their custodians. When no living and correct beneficiary is named, the account is forced through probate court. Average probate costs run between 3 and 7% of the asset value and routinely take 9 to 18 months to resolve. On a $180,000 IRA, that is $5,400 to $1,600 permanently gone in fees and court costs, plus months of delay and avoidable family stress. Marcus, a 38-year-old product manager in Denver, discovered that his old 401k from a previous employer still listed an ex-girlfriend from 8 years earlier as the sole beneficiary. He spent 17 minutes one afternoon logging into every account he owned and correcting the names. Nothing about his daily spending or lifestyle changed. The quiet risk of 6 figures going to the wrong person simply disappeared. Rule: if the person who should receive the money is not the exact name currently on file, fix it before you do anything else with new money. Once the simple paperwork is clean, the next quiet layer is protection against the income loss most high earners still treat as someone else's problem. Number 2. Proper long-term disability insurance. The Social Security Administration states that 1 in 4 of today's 20-year-olds will experience a disability lasting longer than a year before they reach traditional retirement age. Group coverage offered through work usually replaces only 60% of salary, and the benefit itself is taxable income. A solid individual policy can replace 60 to 70% of income on a tax-free basis and can be structured to continue until age 65 or later. Cost example: a healthy 40-year-old earning $160,000 typically pays between $90 and $140 per month for quality coverage with strong definitions of disability. That is $180 to $1,682 a year to protect roughly $96,000 to $112,000 of annual after-tax income. 2 years of uncovered disability can erase a decade of careful saving and force the sale of assets at the worst possible moment. Priya, a 42-year-old attorney in Chicago, bought coverage after watching a colleague's family completely drain their emergency fund and then begin selling long-term investments during a 12-month recovery. Her own policy has never been used. The premium is automatically drafted each month and feels invisible. The downside risk it removes is not. Rule: income is the engine that funds every other upgrade on this list. Insure the engine before you upgrade anything that shows. With earned income protected, the next quiet move is liability coverage that sits completely outside ordinary auto and homeowners policy limits. Number 3. Umbrella liability coverage. Data from the Insurance Information Institute shows that the average cost of a $1 million personal umbrella policy is $150 to $300 per year for most households with clean driving and claims records. Standard auto and homeowners policies often stop at $300,000 or $500,000 in liability protection. A single serious lawsuit involving bodily injury or significant property damage can exceed those limits in medical bills, legal fees, and settlements within a matter of months. Arithmetic: $250 a year for an extra $1 million to $2 million of coverage equals less than 70 cents a day. One avoided claim of $800,000 saves more than 3,000 years of premiums. The policy itself is almost never seen by anyone outside the insurance company and the attorney who might one day need it. David, a 45-year-old sales director in Raleigh, added a $2 million umbrella after a neighbor's dog-related incident forced him to calculate his actual net worth exposure for the first time. He has never filed a claim and has never mentioned the policy to colleagues or friends. It simply sits there, quiet and unused. Rule: buy the coverage that only pays when something goes badly wrong, and almost no one will ever see the paperwork. Protected against large personal lawsuits, the next upgrade is making the money you already earn work harder while you do nothing different. Number 4. Automate maximum practical retirement contributions. Vanguard's 2025 How America Saves report shows that participants who raise their contribution rate by even 1% and keep the new rate fully automated accumulate substantially more wealth over decades. A 35-year-old earning $140,000 who moves from a 10% deferral to 15% and stays consistent can add roughly $280,000 to $350,000 in extra balances by age 65 at long-term moderate returns, before counting any employer match. The mechanical step of changing the percentage inside most payroll or benefits portals takes less than 10 minutes. The lifestyle adjustment required to absorb the lower take-home pay happens only once. Elena, a 37-year-old operations manager in Minneapolis, raised her contribution from 8% to 15% on a Tuesday morning. Her take-home pay dropped by about $420 a month. She trimmed a few discretionary categories once and never revisited the number again. 7 years later, the difference in her accounts is already material and remains completely invisible to anyone outside her household. Rule: raise the automatic transfer first. Lifestyle adjustments follow the money, not the other way around. With more capital compounding quietly in the background, the cash you still keep liquid needs to stop transferring purchasing power to the bank every single year. Number 5. Move cash reserves to higher-yielding safe vehicles. As of mid-2026, many high-yield savings accounts, government money market funds, and short-term treasury vehicles pay between 4.2 and 5.1%. Traditional bank savings and checking accounts at many large institutions still sit under 0.5%. On $80,000 of emergency and near-term cash reserves, the annual difference is $3,000 to $3,700 in pure additional yield. Over a 10-year period, even without any additional deposits, that gap compounds into 5 figures of pure opportunity cost that never appears on any social feed or status purchase. Transferring the money usually requires one focused online session and a few business days for full settlement. James, a 41-year-old engineer in Portland, moved his 6-month reserve from a legacy checking account that paid almost nothing into a treasury money market fund. He checks the balance at most twice a year. Nothing about his spending patterns or visible lifestyle changed. The extra yield simply appears each month. Rule: cash that sits below the rate of inflation is slowly transferring wealth to the bank. Move it once and leave it alone. Once cash is finally efficient, the next quiet upgrade is a written rule set that prevents the emotional mistakes that cost far more than any management fee. Number 6. Write a one-page investment policy statement. Repeated studies from Dalbar and other independent research firms show that the average equity fund investor underperforms the very funds they own by 1.5 to 3% annually because of timing errors, style chasing, and panic selling during drawdowns. A simple written policy that states target allocation ranges, rebalancing triggers, contribution schedule, and clear rules for new money removes most of those discretionary decisions before emotion can interfere. Creating the one-page document takes under an hour when markets are calm. Reviewing it once a year takes 15 minutes or less. Sophia, a 39-year-old marketing director in Austin, wrote hers after a company stock sale left her with a concentrated position and a strong urge to try to time the next market move. She has not changed her stated strategy through 2 meaningful corrections. Her accounts reflect the difference in behavior, not in any public declaration or performance screenshot. Rule: if the decision is not already written down, you will invent a new one under stress. Write it when you are calm. If this is the kind of quiet money conversation you want more of, subscribe so the next ones reach you without noise. Number 7. Complete basic estate documents. The same Caring.com data shows that the majority of adults under age 55 still have no will, no durable power of attorney for finances, and no healthcare directive. Without these documents, state default rules decide guardianship of minor children and the exact distribution of assets. Court costs, attorney fees, and administrative delays commonly exceed $5,000 to $1,000 to $15,000, even for relatively modest estates, plus months of family friction that could have been entirely avoided. A basic package prepared by a competent attorney or a reputable specialized online service runs between $400 and $1,200 and remains effective until major life changes occur. Marcus, the same product manager from Denver, finished his will, durable powers of attorney, and healthcare directive on a Saturday morning after he had already updated his beneficiaries. His parents and sister now know exactly what to do and what not to do if something happens. No dramatic family conversations were required. Rule: the documents you hope never get used are the ones that protect everyone you care about when you cannot speak for yourself. With the legal basics finally handled, the next upgrade recovers the one resource that cannot be earned back once it is spent. Number 8. Systematically outsource low-leverage tasks. Bureau of Labor Statistics time use data show that the average full-time worker still spends 1.5 to 2 hours per day on household chores, errands, and basic home maintenance. At an effective after-tax hourly value of $60 to $100, for many professionals, that represents $30,000 to $70,000 a year of time, priced at professional rates, but spent on work that almost anyone can perform. Hiring reliable cleaning help, yard maintenance, or recurring grocery delivery for $400 to $700 a month recovers 8 to 12 hours every single week. Annual cost sits between $5,000 and $8,000. The recovered hours, valued even conservatively at $50 each, equal $20,000 to $30,000 of personal capacity returned to you each year. Priya, the Chicago attorney, hired a cleaning service and switched to recurring grocery delivery. She gained back 2 weekday evenings and 1 full weekend morning. She used none of the recovered time to signal status or upgrade her visible lifestyle. She used it to rest and to do the deep work that actually compounds over years. Rule: pay to remove tasks that anyone can perform so you keep the hours that only you can use well. Recovered time is useful only if the body and mind can still perform at a high level year after year. Number 9. Upgrade sleep and recovery systems. The CDC reports that 1 in 3 adults regularly sleep less than the recommended 7 hours per night. Chronic short sleep is linked to measurable drops in cognitive performance, higher lifetime healthcare costs, and reduced earning capacity across decades. A quality mattress, proper blackout conditions, and consistent bedroom temperature control often cost between $1,500 and $4,000 once, and last 7 to 10 years with normal use. Cost per night over an 8-year lifespan falls between 50 cents and $1.40. The improvement in daily focus, decision quality, emotional regulation, and reduced sick days is harder to price to the dollar, yet it multiplies the return on every other item already on this list. Elena, the operations manager in Minneapolis, replaced an 8-year-old mattress and added simple blackout shades, plus a basic white noise setup. Her resting heart rate variability improved within a few weeks. She did not post about the change. She simply stopped waking up already behind and began compounding the hours she had earlier recovered from outsourcing. Rule: the highest return asset you own is the one that has to show up every single day. Maintain it like infrastructure, not like a luxury purchase. Number 10. Install a private annual wealth operating review. Most of the previous 9 upgrades fail quietly over time, not because they were wrong, but because no one schedules the maintenance. Industry data on financial plans shows that households who conduct even a basic structured review once a year keep far higher rates of insurance in force, contribution levels intact, and estate documents current than those who set things up once and walk away. The review itself costs almost nothing except 4 focused hours. Arithmetic is straightforward. One afternoon each year spent checking beneficiaries, confirming disability and umbrella policies are still active and correctly sized, verifying contribution rates, confirming cash is still earning a real yield, rereading the investment policy statement, confirming estate documents need no updates, and recalculating whether outsourcing and recovery systems still free the hours you need. That single block of time multiplies the durability of every prior decision. Skipping it is how good upgrades slowly decay into expensive paperwork that no longer matches reality. Marcus, the product manager in Denver who fixed his beneficiaries and later completed his estate documents, now blocks the first Saturday morning of every February for exactly this review. He spends less than 4 hours. He has never posted about it. He simply knows that the protections he put in place still fit the life he actually has. Priya and Elena follow versions of the same quiet calendar habit. The compounding does not come from new products. It comes from refusing to let the old ones drift. For you, the effect is direct. Every earlier upgrade on this list becomes more reliable. The disability policy still matches your income. The umbrella still covers your net worth. The automated contributions still run at the rate you chose. The cash still earns. The policy statement still governs behavior. The estate documents still name the right people. The recovered hours and better sleep still support clear decisions. Without the annual review, each of those advantages slowly erodes. With it, they reinforce one another for decades. Rule: the meta upgrade is not another product. It is the private system that keeps every previous decision alive and compounding when no one is watching. You now have the full list of 10. Almost none of these moves required inheritance, perfect market timing, a side hustle, an extreme morning routine, or any public display of progress. They required only quiet decisions made at the point when you already had enough income or assets to act without strain. Most of them cost less over a decade than a single status purchase many people in the same bracket make without a second thought, and none of them need an audience to continue functioning. The first 9 items protect the income engine, reduce large and often overlooked downside risks, keep more of your capital compounding instead of leaking, recover hours that cannot be replaced, and maintain the physical and cognitive systems that have to show up for every future choice. The 10th item, the private annual review, simply keeps the other 9 from slowly drifting out of date or out of force. Together they form a closed, invisible system that compounds in the background year after year, while almost no one outside your household ever notices. You do not need to install every item this month or even this quarter. You only need to stop treating the invisible layer as optional or as something you will get to later. The loud upgrades, cars, houses, watches, visible signals, will always be available and will always advertise themselves. The quiet ones become progressively harder to put in place the longer they are postponed, because both life complexity and personal inertia rise with time and with rising income. Which of these 10 have you already handled? Which one have you been quietly postponing, even though you have had the resources for some time? If you made any one of these moves years ago, corrected the beneficiaries, purchased the disability coverage, added the umbrella, raised and automated the contribution rate, moved the cash, wrote the one-page policy, completed the estate documents, systematically outsourced the low-leverage work, upgraded the recovery systems, or simply began the annual private review, write the full outcome in the comments. Not the polished highlight version, the real numbers where you have them, the years that passed, the problems that never appeared, and what remained completely invisible to colleagues, friends, and extended family. Other people reading this need to see the actual, unglamorous return, not another abstract theory. The original test still stands. If a decision only pays you when someone is looking at it, it belongs in the other category. The upgrades that survive a decade of honest hindsight are precisely the ones almost nobody notices. That is the entire reason they keep working when markets fall, when health fluctuates, and when life becomes more complicated. Make the next quiet decision while the window is still open and the cost of action is still low.